What have you got there?
You, the mysterious stranger in my computer that wants to help me and knows everything about me. Thanks to you, I got my first paycheck and cashed it in.
Congratulations. That looks like a lot.
For me, it is.
But, soon it may not be all that much after inflation.
Inflate what?
Inflation. In Germany in the 1920s, you had to fork out several billion for a haircut.
Really?
Followed by the Great Depression in the 30s. This paved the way to the rise of the Nazi Party. So, you see, inflation is the monster in the dark economists fear.
So, what exactly is inflation? And why does it want my money?
Inflation is a generalized rise in prices. You measure the rise by comparing the price of a certain basket of goods over time.
So, if the price of the basket rises, inflation rises?
Right. A common measure of inflation is the Consumer Price Index, CPI, which tracks the price of a bundle that makes up what a typical household buys.
Consumer Price Index, right.
There's also the Producer Price Index and the Personal Consumption Expenditure Deflator.
Say what now?
Those distinctions don't matter much for now. We can just talk about consumer inflation. There are two types of inflation figures: headline inflation and core inflation. Core inflation doesn't count the prices of food and energy because those are volatile and don't represent market trends. Headline inflation, on the other hand, includes everything. Both are important.
What makes prices go up? Why don't they just stay the same?
One reason is cost-push inflation. That's when the cost of production goes up, like prices of raw materials, or salaries that increase faster than productivity.
That makes sense.
Another is demand-pull inflation. That's when there's too much demand. Suddenly there's shortages of all sorts, price hikes, and so on.
I see.
Governments can also cause inflation. For example, if the budget deficit is too big, or if central banks boost the money supply to stimulate growth. The problem then is you have too much money chasing too few goods, and you get inflation.
Man.
And another problem is inflation reinforces itself. Prices rise, so workers demand more money. So companies grant them pay hikes, and a spiral begins. Note how expectations change things. If people just expect prices to rise, workers will demand higher wages, while businesses will set higher prices, and boom, inflation.
So over time, my money can be worth a lot less.
That's right. Now, let's test what else you've learned. Does the following cause a jump in inflation? A rise in the oil price.
Yes, because when that rises, people have less money and they demand more pay.
Right. How about quantitative easing?
I'd tell you if I knew what that was.
It's when the government prints money.
Inflation goes up.
Yes, that can happen. Or at least inflation will be higher than it would have otherwise been. How about a rise in the unemployment rate?
I don't see how.
Workers will accept to work for lower wages, so inflation goes down. What about an increase in sales tax?
Prices go up again and people have less money, so yes.
Excellent.
If there's inflation, I lose, right? But is there someone who gains from it? And who else loses?
The main winners are debtors. Who loses? People who save. People with fixed incomes, like pensioners, and overall the economy suffers. Prices get distorted and everything gets more expensive.
What's the opposite of inflation?
The opposite is deflation, and it's just as bad as inflation. Prices and incomes suddenly fall. Consumers delay buying things because they think prices will be cheaper tomorrow. And the debt of borrowers who owe fixed amounts of money becomes much harder to repay. On the other hand, low inflation is usually a good thing. What should the Fed do? Economists disagree, but most think the Fed should control growth in the money supply and raise interest rates when inflation gets out of hand. The government can also help by balancing the budget or at least reducing the deficit.
And what do people do?
People take into account low doses of inflation. They invest in equities, which have some sort of inflation protection, less in bonds that repay a fixed sum of money. Gold commodities and real estate are also good because they're real assets whose prices tend to rise with inflation.
I see.
Do you? Let's test that. Who of the following benefits most from inflation? A fixed-rate borrower? A floating-rate borrower? A creditor? An equity investor?
A fixed-rate borrower.
Right. Who among those groups has most to fear from inflation? Retirees earning a fixed pension? Stock market investors? Gold mining companies?
Retirees on fixed pensions.
Very good. Which among the following investments offers the best inflation protection? Cash, bonds, or stocks?
I know, stocks.
Very good. Next. Say inflation is 2% per year and you expect it to stay there. You're offered a choice of a regular 10-year Treasury bond paying 3% interest or Treasury inflation protected securities, so-called TIPS, which repay principal that is indexed to inflation but only 2% interest per year.
TIPS.
Wonderful. I'm glad you've learned so quickly.
Absolutely. I learned that money is going to be worth less with time, so I should spend it now while it's worth something.
No. That is not at all the lesson. You should absolutely not. Michael?